All right, let's dive into a really crucial topic for your AS level accounting exams, control accounts. We are going to break down absolutely everything you need to know so you can walk into that exam feeling totally confident. So, here's what we're going to cover. We'll kick things off with the why, the whole purpose of control accounts. Then we'll get into the nuts and bolts of the sales and purchases ledger accounts. After that, we'll untangle a tricky little area called contra entries, put all that theory into practice with a real exam question, and then we'll wrap it all up with a quick summary to make sure it all sticks. So, first things first, what on earth are control accounts? Well, think of them like a master summary account. Instead of jamming up your main general ledger with every single customer and supplier, you keep all those details in separate lists, which we call subsidiary ledgers. The control account then gives you one clean summary figure. It's a fantastic way to check the accuracy of all those little individual entries without getting lost in the weeds. I mean, just imagine a business that's starting to take off. It's fantastic, right? But it creates a massive accounting headache. How in the world are you supposed to manage hundreds, maybe even thousands of individual accounts in your main ledger? It would be a complete nightmare, super inefficient, and the risk of making a mistake would be huge. And this is where the control account becomes our hero. It's such an elegant solution. At its core, it's a summary account. It scoops up the totals from all those detailed subsidiary ledgers and pulls them together into one single, verifiable number in the general ledger. It lets you see the big picture without losing track of the details. What's really brilliant about this system is that it sets up a fantastic internal control called the segregation of duties. You might have one person handling the nitty-gritty details, posting individual transactions. Then you have a different person, maybe someone more senior, who maintains that high-level summary in the control account. This creates a natural system of checks and balances, which makes it much easier to spot errors and much harder for fraud to slip through. For your exams, you really only need to get your head around two main types. First up is the Sales Ledger Control Account, or SLCA. Just think of this as the total money owed to us by customers account. And the second one is the Purchases Ledger Control Account, or PLCA. This is your total money we owe to our suppliers account. Simple as that. One for money coming in, one for money going out. Okay, let's take a closer look at the Sales Ledger Control Account. Now, it's absolutely crucial to remember that this is an asset account. It's money that's owed to the business. And what do we know about assets? They have a normal debit balance. All that means is that the default state of this account is a debit, which just represents the total amount we're expecting to receive from all our credit customers. So how do things move in and out of this account? It's all based on simple logic. Anything that increases the total amount our customers owe us is a debit. The biggest one, obviously, is making a new credit sale. On the flip side, anything that decreases what they owe us is a credit. This is things like when they finally pay us, or if they return some goods, or if we give them a discount. But hang on, what if this account ends up with a credit balance? That feels a bit weird for an asset, doesn't it? Well, this is what we call an abnormal balance, and it just means that for some reason we actually owe a customer money. It can happen pretty easily. Maybe they overpaid their bill by mistake, or paid us in advance, or maybe they returned some items after they'd already settled their account. All right, let's flip the coin and look at the Purchases Ledger Control Account. Now, if the Sales Ledger was an asset, this one is a liability. It represents money the business owes to other people. Because of that, its normal balance is a credit balance, showing the total amount we have to pay all of our suppliers. The logic here is pretty much the exact reverse of the Sales Ledger. Any transaction that increases what we owe to our suppliers gets credited. The main one here, of course, is when we buy goods on credit. And anything that decreases what we owe gets debited. That's things like when we pay our suppliers, return goods to them, or when they give us a discount for early payment. And just like the sales ledger, we can get an abnormal balance here too. A debit balance in this account means a supplier actually owes us money. It might sound a bit strange, but it happens for similar reasons. Maybe we overpaid an invoice, or paid for goods in advance, or we sent something back for a refund after we'd already paid them in full. Okay, let's talk about a special situation that examiners love to test, the contra entry, or what's sometimes called a set-off. This is a neat little accounting trick we use when the same company or person is both our customer and our supplier. It's really just a way to cancel mutual debts against each other. I mean, if we owe them money and they owe us money, it just makes sense to net it off, right? The key rule to remember, and it's a big one, is that you always use the smaller of the two balances for the set-off. What this does is neatly reduce both our receivables and our payables. Let's use a quick example to make this crystal clear. Say our customer, A. Smith, owes us $500, but at the same time, we buy supplies from them, and we owe them $200. Instead of us both sending checks in the mail, we can do a contra entry. We take the smaller amount, the $200, and we set it off. This completely wipes out our debt to them, and it reduces their debt to us, leaving just a simple $300 balance that they still owe. Much cleaner. So what's the double entry for this? Well, we need to reduce both balances, right? To reduce what we owe in the purchases ledger control account, we debit it. And to reduce what they owe us in the sales ledger control account, we credit it. Both entries are for the same set-off amount, so our debits and credits are equal, and everything is perfectly balanced. Okay, theory's done. Now for the fun part. Let's put it all into practice. We're going to walk through a typical exam question where you have to build a control account and find a missing figure. So here's the mission. We've got a whole list of figures for a trader. Our job is to take all this data, piece together the purchases ledger control account, put every number in its correct place, and solve for the one missing piece of the puzzle, that closing credit balance. Okay, let's build this account together step by step. First, we pop in the opening balances. The normal credit balance of $21,400 goes on the credit side. That abnormal debit balance of $130 goes on the debit side. Next, credit purchases. That increases what we owe, so we credit the account with $253,790. Now for all the debits, the things that reduce what we owe. Returns outwards of $22,860, checks paid from the bank of $201,300, discounts we received of $4,640, and that contra entry of $1,200. All of those go on the debit side. We're also told there's a closing debit balance of $180. Since that's a balance we're carrying down, we post it to the credit side to close it off. Okay, let's total up the credit side. $21,400 plus $253,790 plus $180 gives us a grand total of $275,370. Since the account has to balance, the debit side must also total $275,370. The final step is to find our balancing figure. We take the total of $275,370 and subtract all the other debits. And that gives us our answer for the closing credit balance, $45,240. Phew, we've covered a lot of ground. So let's wrap this up by quickly running through the absolute key takeaways. Nailing these core concepts is going to be a huge help for your revision. So just remember, control accounts aren't just for summarizing. They are a super powerful tool for internal control. And here's probably the biggest exam tip I can give you. Never ever include cash sales or cash purchases. These accounts are only for credit transactions. If you can really get comfortable with the debit and credit rules for assets versus liabilities that we talked about, you'll be in great shape. And I'll leave you with one final question to think about. If that control account total doesn't match the total from the detailed list of individual accounts, what does that tell you? Well, it's an immediate red flag. It signals that there's an error somewhere in the books. This is what kicks off an investigation called a control account reconciliation, which is how accountants play detective to find and fix the mistake.